crypto was made by engineer for engineer, and so we kind of left a lot of people on the sideline because it was so difficult to use. We need to make this accessible for everybody.
I think we're starting to enter a phase now where we start to see more integration of consumer or retail crypto with other applications. So it's not only, although it is significantly about holding assets, moving assets, it's also integrated with the kinds of experiences that people have online.
And in the financial system, it's just gonna have a huge impact globally. And so in the end, though, I think all of that is a reason to be very bullish because I think as that happens, it's a mega unlock to global adoption of this technology.
My name is Tanya Denisova, and it's my pleasure to be hosting for you guys today. I'm the Chief Operating Officer of Robinhood Crypto. I've been at Robinhood for 4 years, and I've been in crypto for the last 8. I'll be passing it to each of the panelists to introduce themselves, starting with our very own Johann.
Hello, everyone. I'm Johann Kerbrat. I'm the General Manager of Robinhood Crypto. Also been at Robinhood almost for 4 years.
Hi, everyone. I'm Ed Felten. I am co-founder and chief scientist at Offchain Labs. We're the developers of Arbitrum, which is a leading layer 2 scaling solution for Ethereum.
And I know you guys just heard from Jeremy. Let's give him another round of applause for his keynote.
Thank you.
Great. Well, today we'll be discussing the evolution of cryptocurrency and the applications of blockchain technology over the years, starting with a topic that is very near and dear to us at Robinhood around making crypto more accessible and lowering the barriers to entry. John, I'll start with you. How have we seen retail behavior change over the years in terms of interaction with cryptocurrencies and blockchain technology? What would you say?
Yeah, I think it's an interesting one. When blockchain appeared, everyone was thinking like, this is going to change completely payments. This is going to remove banks' needs and all these kind of things. But the reality of it is something that I say often is crypto was made by engineer for engineer. And so we kind of left a lot of people on the sideline because it was so difficult to use, It was very impressive at the beginning. You have to remember your seed phrase. You have to understand what is the protocol, what is the consensus. And I think there is often too much focus on that. Like we need to focus a bit more on the application. And I think that's what has been happening in the past few years. Like company like Robinhood have been breaking kind of the barrier to entry into the crypto space. And slowly we're seeing people actually embracing it more and more and using it as a collateral from their local currency, engaging into the space, using it for many items like social and gaming now. So, we're starting to slowly see this progression, and it's because we need to make this accessible for everybody.
Yeah, absolutely. Jeremy, what would you add to that?
Sure. I mean, I've sort of watched this from when I got started in this 12 years ago, where this was, you really just had Bitcoin. It was very difficult to get involved, very complicated. But I think it's evolved pretty massively. I mean, in the numbers of retail users today that interact with crypto networks and blockchains is in the several hundred million. That's a big number, and it's poised, as I noted before, to grow really dramatically. And a lot of the original promise from a retail perspective was this is going to be a better way to kind of store and move money. That was a lot of the people were excited about how do we improve the financial system with more access and make it more efficient and the like, and like that's now happening. And we've seen this with USDC just in the past couple of years. We've seen dramatic growth in the use of USDC as an everyday store of value for people all around the world that want to store digital dollars. And we're seeing, likewise, a very significant increase in small businesses, medium enterprises in emerging markets that are finding this as a better way to conduct trade and settlement and individuals to move money. I just as a small personal anecdote, I just in a taxi ride yesterday, a friend was like, how do I, take advantage of this to like move money to South Africa? And I literally, I had him, and this is like representative of how fast the change is. He was able to like onboard into a wallet, get USDC without any fee, and then with his counterparty in South Africa, who was using an exchange, Valor, which uses USDC, he was able to actually transmit the USDC directly to his counterpart in South Africa in literally like seconds with no fees. And his mind was blown. He was like, how is this even possible? And so we've seen huge improvements in terms of the user experience, and really starting to fulfill the promise that got so much of us into this industry, over the past decade.
Absolutely. Ed, anything to add?
Sure. Let me agree, and then add, I think we're starting to enter a phase now where we start to see more integration of consumer or retail crypto with other applications. So it's not only, although it is significantly about holding assets, moving assets, it's also integrated with the kinds of experiences that people have online. And so the wall, if you will, between crypto and the rest of the online internet experience, I think is starting to dissolve. And I think that's going to be a big trend. We see that in areas like gaming, for example. But I think we're going to see retail crypto being part of the experience, and often as sort of under the hood part of the experience more and more.
Yeah, I agree. But we're not all the way there. What are some of the major blockers or challenges still standing in the way of true mass adoption for crypto? Ed, what do you think?
I think it's several things. First, there are still trust and safety issues that we, especially those of us who are building sort of base layers or infrastructure, need to really take care of. There has been a sort of Wild West culture in parts of the crypto world, and making sure that we can deliver the trust and safety that consumers need and deserve is, I think, really important. I think number two is user experience. We need to provide a level of user experience that is well beyond the early adopter user experience, and one that really meets the needs of consumers. And then third, and this is something that I think about a lot, because in the Arbitrum world, we are really focused on building the basic rails on which this activity can happen. Just making sure that the infrastructure that supports all of this doesn't get in the way, that you can provide the security, the reliability, you can provide the response time, you can provide the cost, and you can scale up to the scale that's needed. We're still working on that, because although we've made a ton of progress, as Jeremy said earlier, transactions faster than 1 second cost less than 1 cent per transaction on a secure network. We're still working on issues like scale to make sure that we can support the very large market that I think is waiting to move on to this technology.
Yeah, absolutely. John, anything to add?
I think Ed says almost everything I could have think of, but I think education is also a part that has been missing in a lot of places, and that's something that at Robinhood we spend a lot of time on. We want to make sure that people actually can understand the differences between the different chain, how to use it, how to transfer, what are like the issues that you have when you try to send money somewhere or try to receive it. We still see a lot of scam in the industry, and not just because of crypto, just because it's the way the world is. And so our main concern is how do we protect customers and also help them get into the space in a safely way.
Jeremy?
I'll add one thing which builds on something I said earlier, which is I believe, in the United States in particular, but certainly in other parts of the world, is we have to have legal certainty. Because if we don't have legal certainty, it will not be used on a mass scale. We have to have stablecoin money defined as legal money in the United States at a federal level. We have to have definitions for like blockchain tokens and digital tokens and how they can be used. Corporations will not integrate this into what they do. They're afraid to do it. Financial institutions getting mixed signals from regulators. We have to have settled law. It has to happen in 2025. I think the good news is it seems like it will. But that is, to me, in some ways, all the infrastructure problems, the UX problems. I agree with my counterparts here about where we are with that. But if we can get that legal certainty established, then everyone will know where they stand and will be able to safely start building and using this on a mass scale.
Yeah, absolutely. Great points. Thank you. Now, we touched a little bit on this just now, but of course, it's no longer just about Bitcoin and Ethereum. We really do see so many varied applications and use cases on different chains, some that span across multiple chains. And my question to you all is, how have we seen those be implemented in an accessible way to the retail user base? And what are some of the more impactful ones that we've seen users take advantage of and use in real world ways? And also, what are some of the challenges or points of confusion that we see newcomers especially stumble over as they make their way into the DeFi world? And Ed, I'll start with you.
Sure. Yeah, we've seen, I think you can look at what's happened in the Ethereum world over the recent years here, right? First, Ethereum was a chain providing a really high degree of flexibility and security. Then we started to see the growth of the layer 2, the L2 ecosystem. Arbitrum, the system we developed, is a part of that. And there were, say, a handful of significant layer 2 chains, each of which was aiming to be a kind of hub for a lot of activity, while providing the same level of security as Ethereum. But now we've seen this explosion of application chains. And one of the ways the market has moved is that instead of providing a chain, a team like ours is now looking at providing a toolkit and that anyone can use to build and run their own chain. And so we've seen this explosion of app chains. And I think that the risk there potentially is one of fragmentation. That not only fragmentation of liquidity, but fragmentation of user experience and complexity for users. And frankly, I think we need to find this kind of balance point where we are providing users with a reliable and understandable experience, while at the same time allowing customization and innovation to occur. And I think that push and pull is still going on with respect to the app chain world. I see progress, but there's still more work to be done.
Mm-hmm. Absolutely. Jeremy, what are your thoughts?
Yeah, I mean, we think about this a ton, and I think we've tried to solve for this in a couple ways, which is just making sure like your digital dollars can work wherever there are applications and developers that are doing things. And so, we work on Arbitrum, we work on 16, probably be 25, 30 networks by the end of next year. And so there are this proliferation, but it is introducing all this complexity. And so a couple of things that we see. One is, interoperability layers that make it very easy for people to move across these environments and abstract that away. Like if I'm in a Web3 wallet or super app, like I don't want to know what a blockchain is. I don't want to know what blockchain I'm on or someone else is on. I want to be able to just like go to an app and use it, or send money and have someone receive it. And so there are abstractions around naming across blockchain networks. There are protocols like CCTP for dollars and euros and other things to sort of transact. And then abstracting away, the need for people to know what gas is. Like how many people here know what gas is? Putting in our cars, whatever. But like it's kind of ridiculous. And like if you use, like the number of pop-ups that fly up in a Web3 wallet to like do something is a complete joke. It's just a disaster. And so we have to basically push that down, push the signing and security stuff down, eliminate the need for that, and allow people to just, if they have a dollar balance or digital euro balance, to be able to like use that if there's transaction fees, or let developers just pay behind the scenes. Like if I use Netflix, there's not a line item in my bill that says AWS fees. Like we have to move away. So from all those things, and I think the good news is lots of people are working on this at the standards level, and lots of people are working at this. We're certainly trying to work on this, and I think this sort of concept of chain abstraction is very real, and there's a lot of pursuit around that. But we have to also acknowledge that we're in like what I call the pre-iPhone era of blockchains, which is to say, like if anyone here was around when mobile was sort of pre-iPhone, right? There were like 17 different mobile operating systems. There was the Nokia environment, NTT, Windows Phone, Palm Pilot, BlackBerry, on and on and on and on. Most of it was total garbage. People were excited about it. There was no iPhone. There was no Android. There were no like significant platforms that had basically kind of become the service areas. And I'm not saying that's exactly what's going to happen in the blockchain ecosystem, but it might. You might get a power law curve that goes there. And we're seeing some significant growth in the Base ecosystem because of Coinbase verticalization and the Solana ecosystem. Arbitrum continues to be a really dominant network, and now with Orbit is enabling lots and lots of other people to launch apps and sort of L3s, or I don't know what you guys call them, but
Yep.
but,
L3s.
Yeah. So I think we're going to continue to have proliferation, and so these abstractions are going to be really core. But like I said, I think we are approaching a point where a user can kind of safely and easily get online and begin to transact and interact across these platforms, and have a lot of that become invisible to them, and have it be more familiar with, more similar to their Web 2 type experiences.
Mm-hmm. Yeah, great points. John, what would you add?
I think it's totally right. So, a lot of things that we do at Robinhood is to talk to investors and understand like what are the pain points and the issues that they are seeing. And through like conferences like this and interaction like this, we were able to really understand why are they not trying to get more on-chain. And at Robinhood, we have a lot of new investors that have never touched, crypto before, and especially not in DeFi. So when we launched our self-custody wallet, Robinhood Wallet, a lot of the feedback was, I can buy crypto on Robinhood or on any other platform, but as soon as I transfer it to a self-custody wallet, I'm kind of getting lost in translation, and I don't really know what to do with it. So when we build the wallet, we really try to create the same UI and UX that Robinhood is famous for. We wanted to make sure that people will not get lost when they get there. We made USDC actually the main currency of the wallet, so you didn't have to do this conversion in your head constantly with Bitcoin. And we were the first one to launch transaction with no gas. So that was a big thing where, if you want to convert one asset to one asset, you don't necessarily want to have the gas token, and because maybe you don't even know what the gas token is. So our goal was really to create this kind of browser to access all the Web3 dApps and really get into a world where, it's just like you using your internet browser or you using your phone with the apps. And I think we just need to keep doing that. And it's a role of platform like Robinhood to be actually able to use the blockchain that Arbitrum is developing and the token that Circle is developing, and making sure that it's seamless to the end user at the end.
Mm-hmm. Yeah, absolutely. Thank you all. Really great points. I want to switch gears here a little bit and talk about something that's been a bit of a hot topic, especially in the United States, which is regulation. And I want to ask, what is important from a regulatory perspective for companies who want to be compliant with the laws and regulations of the jurisdictions in which they operate? I know, Jeremy, you've touched on this before. Do we have that today? If not, what's missing?
We could do 10 panels on this topic alone. Obviously, we're going to keep it to, I don't know what this is, 4 minutes.
Keep the highlights.
So I think there's like good news and there's bad news, right? On the good news side, digital asset policy and regulation is like a top thing in almost every major jurisdiction in the world. And we've seen some really sweeping new rules come into place. In Japan, they've been out ahead of this for a long time. A lot of people are aware of MiCA in Europe. So we're talking about the European Economic Area, nearly 800 million people. They have the most comprehensive new digital asset regulatory framework that provides the clarity that's necessary for everyone from exchanges and wallets and custodians to just businesses that want to know what these assets are and use it, and stablecoins as well. So, USDC and EURC, our Euro stablecoin, are the two largest, regulated, forms of legal electronic money now in the blockchain space in Europe. And so that clarity is really key, and that's happening in a lot of places. So if it hasn't already happened, 2025 is definitely like the year of policy advances everywhere, including in countries that historically have been perceived to be hostile. I think countries like India will make progress in this, and so that's really encouraging. That's the good. I think the bad is that here in the United States we don't have that, and we have a patchwork of kind of pre-existing laws. A lot of it is not suitable to the nature of digital assets. We need federal laws on stablecoins if you really want this to be treated as cash money in the financial system. And you have obviously, regulation by enforcement, which is well known to a lot of companies in the space. And so, the only way to solve this is with Congress doing what Congress is meant to do. It's not to have the courts adjudicate this, is to have Congress really establish that. And so that's sort of the bad news, is that we're not quite there. But for those that are paying close attention, there's been huge progress in terms of bipartisan support for comprehensive laws around stablecoins and digital assets. And so I think everyone is very optimistic about that happening here in the United States. And I think then the rest of the world who hasn't moved on this will follow extremely fast, because maybe the U.S. is a little bit late to the party relative to some. It's the impact of U.S. law, given the role of the United States in the global economy, in technology, and in the financial system, is just gonna have a huge impact globally. And so in the end, though, I think all of that is a reason to be very bullish, because I think as that happens, it's a mega unlock to global adoption of this technology.
Yeah, hopefully. John, what would you add?
Yeah, I think it's no surprise. Like a lot of people are aware that Robinhood is also in this kind of situation with a regulation by enforcement, and even though we spend many months and visits with the regulator, we still got a wealth notice. So that was something that was extremely disappointing. I think what is the most frustrating for me personally is, like, I immigrated to the US because it was like the nation of innovation, and at the time, like, crypto was really booming, and now we are seeing that we are a bit late compared to the EU. Like, the fact that even the EU can have a framework that is more comprehensible before the US is kind of something that is hard to swallow. But hopefully, like Jeremy said, we can get something at the federal level, and we won't have like all this complexity to operate in every different state. But there are also good news, like, for example, now Robinhood is available in every state in the US, including Hawaii, including Puerto Rico, and that was not necessarily easy to do as a company. And we're seeing also a lot of traction coming in Latin America. Like, Brazil is working on a fairly comprehensible framework as well, and we're starting to see that in Hong Kong, in Singapore, in the UAE. So, the world start to embrace it. And at the end of the day, if you think that 12, 13 years ago, when Bitcoin was starting to emerge, and you look at the election, and now it's becoming like an issue that we are talking regularly on TV with presidential candidates, it does show that we went a long way, and now it's becoming an actual problem that we want to solve. And seeing like the progress that we've made at the bipartisan level has been very interesting to see. So hopefully 2025 will be the solution.
Yeah, absolutely. It's ever evolving, so definitely something to watch. I want to switch over to another very hot topic lately, which is AI. AI is, of course, starting to be used in a lot of really interesting and meaningful ways across tech. What are some of the ways that it can be leveraged in the crypto space? And Ed, I'd love to have you kick us off.
I mean, you can sort of look at this in two ways. You can ask, what can crypto do for AI? And you can ask, what can AI do for crypto, right? So in terms of what can AI do for crypto, basically you can have, and we're increasingly seeing AI-based actors that are involved in crypto markets, and you're seeing services that are connected to and operate in on-chain that are controlled or monitored by AI. And I think that's an important trend. The other side of this is, what can crypto do for AI? And that is, what happens if you take an AI model and you actually put it on-chain, right? The big thing that at the base layer crypto does for computing and for the relationship between people and technology is it provides a level of transparency and accountability about what's happening with the computation, right? Because the code that is implementing that application, at least the on-chain part, is available for everyone to read and diligence, and you have a guarantee that it's executing as it's supposed to. So if you take a crypto model and you put it on-chain, now you can have a set of people who agree that we're going to have, say, some market that is mediated by, operated by an AI agent. And people can know what that AI agent is, and they can make sure that it's operating as it should. Now, there are a lot of technical challenges involved in getting to there, because the evaluation of AI models is pretty computationally expensive. The models tend to be big. But I think it's a coming thing. You're seeing a lot of exciting work being done to bring AI agents on-chain so that they can become an integral part of these sort of on-chain core markets that people are then building experiences around.
Yeah, absolutely. Jeremy, what are your thoughts?
Yeah, I mean, there's so many different sort of subtopics in this as well, and I'll ladder a little bit off of some of Ed's comments, but I think as noted, right, blockchains are really, really good at kind of providing cryptographic proofs of data and of compute outputs. That's a huge technical breakthrough. That's why it's such an important breakthrough. And in some ways, it's not maybe coincidental that we're having the proliferation of this mechanism on the internet that can prove the source of data, or prove the authenticity of something, and prove the work conducted by a computer at the same time that AI is emerging as well. They're almost like hand in glove. And so people talk about intellectual property rights getting kind of demolished by AIs, and you use a ChatGPT and you're like, well, where did it get all this data? And then writers are saying, well, you took my data. And so how can we solve for a problem where essentially the training models for these AIs have basically their data limited? And so to get the next order of magnitude improvements in the intelligence of these systems, they just have an insatiable appetite for data. Well, so the model for how data is provided on the internet has to change. We have a paradigm today, which has evolved really over the past 30 years, frankly, but from 1994, when the web really kind of emerged, which is essentially all your information is put up on the World Wide Web, and that's crawlable by search and other bots. And we all have this kind of deal where like we put our content up, and people sell ads to intermediate the discovery of that content, and that's sort of the business model of the internet. And that happens through social discovery, it happens through search engines and the like. But now the user experience paradigm of the internet is completely changing radically. Like I spend a lot less time on websites and I spend much more time in Perplexity and ChatGPT and other tools. And that's only going to proliferate. If you saw Perplexity Finance, for example, that just launched, extraordinary, right? So the UX layer is going to change, and therefore the entire way that data is made available is going to change. And so we need a way for the AI bots, which are scavenging for data, to be able to compensate data providers. We need a way for the data that is provided to have proof that it's being kind of used appropriately. And then we need a compensation model that is going to be mediated by blockchains. And I believe that compensation model is very likely going to be in stablecoins, because it needs to be universally acceptable, machine transactable, and you need to be able to do it in streaming usage of payments, microcents, all these things that only become possible with this kind of technology. And so I think that's one area, which is essentially how does data get used, how is it compensated, consumed, distributed, and then ultimately how do you, when you're dealing with these new sources of intelligence, how do you access that? So I think that's one big area. And then the other is again, laddering off of Ed, but sort of agentic applications, which we're right on the cusp of. I guess my view would be, probably a year from now, we'll probably be seeing a fairly extraordinary explosion in agents that perform work. And these agents will be able to collaborate with each other. And so we're going to go on a curve, I think, a back half of 25 into 26, where kind of agentic computing and agentic applications kind of take off in a massive scale. There'll ultimately be hundreds of millions of agents that are collaborating and conducting work on our behalf and on behalf of corporations and doing things. And they'll need to have an economic layer for their work. And that the only economic layer that can do that is blockchains and smart contracts and stablecoins. And so I think, again, as the economic system is increasingly executed and intermediated by AIs, that's going to create a huge demand driver for stablecoin money and blockchain infrastructure as well.
Yeah, good points. John, what would you add?
Well, I think the ethos of crypto and blockchain has been around decentralization, and what we're seeing in AI right now is the opposite of it. You have OpenAI, you have XAI, you have Gemini. All of these are being trained by massive groups that have the mean to buy like the GPUs to train their model. They have the mean to do crazy deals with Reddit for tens of millions of dollars to train their model. And so I think at this point, if you are a small startup and you're not able to raise hundreds of millions of dollars, you won't be able to really compete. And I think that's where blockchain can really be successful. On the energy side, on the GPU side, you will be able to rent the GPUs from another company, not necessarily using them at this point, and you will be able to pay for training your specific model, or you will be able to access to the energy and potentially have it at a lower cost. Like we're starting to see a lot of deals right now happening around nuclear from Microsoft and Google. And energy is going to be like one of these really key components for the next like 10 years about the AI training. And it's something that we know pretty well on crypto with the ASICs and how much energy we needed for that. And the second part is, I think on the data point is going to be key, like micropayment that will be able to remunerate the people that we are training the model based on. And every time the model is being used, being able to give back to the customer that helps build the model is going to be extremely important. I think without that, we will basically just have like three big systems, and we will be very dependent on what they decide to do, the censorship that they decide to apply, the way they have trained their model, and the bias that will come with it. And so I think, blockchain is really going to be the way for us to have an AI that actually look like us and not just look like three companies in the world.
Mm-hmm. Yeah, absolutely. All great points. Big topic, obviously, and definitely another space to watch. Speaking of developing spaces to watch, our last topic for the day is tokenization. We're starting to hear more and more about tokenization in the space. What does that really mean for customers? Is this a real crossover that we're seeing between the TradFi space and DeFi technology? John, I know you spent some time on this.
Well, I think tokenization is always a hot topic, but it's been going on for a while. I think, USDC and stablecoin is probably the first real example of tokenization of a real world asset. And that's the first one that we're seeing being really used at scale and in different countries, not just in a particular setup. But I do think for us, especially at Robinhood, we know the traditional finance system. We also know the crypto system. And that's the intersection of the two that can be really, really powerful. If you remember in May, for example, we celebrated going from T+2 to T+1 on settlement. And, for us in the crypto space, it's a bit laughable, right? Like the worst case situation would be 10 minutes with the Bitcoin confirmation time. So I really think that if we're able to use tokenization and combine it with some of the assets that people are using on a day-to-day, we'll be able to increase liquidity, increase accessibility. It won't be limited to specific hours. We'll be able to reduce settlement time, margin requirements, all these kind of things that will really make the technology useful for something that people are using at mass scale. There are a lot of things happening in the world. Like in the EU, for example, they have a DLT program that kind of allows the tokenization of stocks, but it's very limited. It's only some companies that can use it. There are limitations on the monthly usage of the product and all these kind of things. So I think in the next couple of years, we're going to see a lot more application.
Perfect. Jeremy?
I think thanks for the shout out. Like tokenized cash is here. We have that, and it works, and it's working at a huge scale, and it's becoming a defined form of legal, money, which is pretty awesome. I think there's sort of the TradFi coming on chain, but what's interesting and what I think we're seeing. The most fruitful thing right now is essentially TradFi structures being implemented in the on-chain world. And so it's sort of crypto markets themselves increasingly borrowing from, TradFi structures, as opposed to, stocks are being tokenized and traded in DeFi. Like that's not a thing. I mean, there are synthetic exposures and things like that, but it's not really a thing. But you are seeing things like tokenized money market funds, where you're basically tokenizing kind of treasury collateral or other forms of base collateral, which are intrinsic to capital markets and how they function today. That's actually, kind of like the next logical building block alongside tokenized cash. You have tokenized cash, and then you have kind of tokenized collateral, and obviously the sort of lowest risk types of collateral. And so you're seeing that's actually grown reasonably. There's almost $2 billion of various types of tokenized treasuries, repos, et cetera. But you can imagine that being a lot larger. And then the structures that you see in traditional markets, where you've got a custodian that you're holding that, and then the exchange is willing to give you a margin loan in a stable coin based on the collateral that you have over here. And they have tri-party, kind of structures around liquidation, and which is, again, familiar structures to anyone that is in the guts of the way capital markets work. You're seeing that actually in Bitcoin markets, right? You're seeing that in those markets. And so to me, that's actually, it's not so much that TradFi is coming into DeFi. It's really TradFi structures are coming into what we call CeFi, centralized on-chain financial space. And that has a lot of potential right now. I think it's certainly created an opportunity for folks like Gartner to say this is going to be a $5 trillion market or whatever. So there's a lot of excitement about it, and clearly other instruments like corporate bonds, even sovereign debt issuance. I think my own view is that debt in particular maybe one of the most interesting and ripe areas for tokenization. And so that's something we're paying a lot of attention to.
Yeah, really interesting.
So yeah, we're seeing a lot of this. Certainly, obviously, the success of stablecoins and the move of things like money market funds on chain, such as what Franklin Templeton's doing on Arbitrum. But really, as more of TradFi structures become tokenized, I think you see a huge unlock, both because of the reduction in friction, potentially in what people can do with these assets, but also because of the ability to sort of unlock the innovation, the idea that crypto is the internet for money. Now, as you move more TradFi type of assets there in a tokenized way, you start to see these unlocks happen, where I think we'll see more applications that and faster pace of innovation in the way that people structure markets and the opportunities that are opened for traders or for ordinary users.
Yeah. Awesome. Well, thank you all for your really thoughtful responses and a great discussions. Give the panelists a round of applause.